Sorry to say, but covered calls are not income, and covered calls generally are not a great portfolio management strategy for the vast majority of investors. Before I get more into my thoughts on the flaws of a covered call option strategy, I want to disclose that none of this is investment advice. Please do your own research or have a financial advisor help you with these things. And on top of that, there are niche circumstances, which I'm not going to get into here, where covered calls make sense. So a lot of this depends on a person-by-person basis. But with all the disclaimers out of the way, let's get to the crux of this video. The covered calls are not a viable strategy. They're sold as like some way to get passive income, and it's a low-risk way to get some extra yield on your existing equity holdings, or to add some juice to recently added equity holdings. Even like when you look at brokerage accounts where they rate the safety of various option strategies, covered calls are considered to be the quote-unquote safest strategy other than cash secured puts among many brokers. What I'm going to go into is I think a lot of the consensus on this is flawed, and I think it applies whether you're dealing with an index-focused strategy, like using, say, like the S&P 500 for a covered call strategy. There's even a lot of ETFs that are built on the backbone of just having a semi-automated, regular covered call strategy on major indexes and then paying out the premium as a dividend. Or it also applies with single stocks too. But let's get started with index. So right now the S&P is at 440 on the SPY ETF, about 4,400 on the S&P 500, and VIX is around its average level in the 14s as I'm recording this. So this is kind of a typical environment to like in terms of expectations on yields for covered calls. And right now, if you were to build a covered call strategy, I'm going to go into the return payout structure, and this will help explain my critique of this. If you buy S&P 500 and you sell the 1 year out covered calls to cover it at the money, you're going to get about 8.8% yield right now, which, hey, 8% yield sounds good. That's about what the S&P has averaged, a little bit less over the last 30 years or so. And then but the thing is that if you sell it at the money, you don't gain really any of the upside beyond the premium that you sold the calls for. If it goes up by less than 8%, you'll get that return. If it goes up by more than 8%, your S&P shares will be called away from you, and you will get your 8% return, and you'll sell your stock, and that doesn't even factor in things like capital gains tax or the like. And then if the stock market drops, then you subtract the value of the option from whatever the decline is. So if the market declines 10%, you lose 2, 20, you lose 12. If it declines by less than 8, you're buffered a little bit. You'll have a small gain when the market has a relatively small loss. So basically you are fixing your upside, and you are taking the vast majority of the downside. And you're saying, hey, wait, Nick, how do you know that if you're going to have the downside is going to be that big if you're wrong and the market's down? Because let's look at the distribution of returns. Here is a chart of the S&P 500 total returns. Like, even if the average return is about 8 to 9%, the variance on the S&P is much higher than that. as you see, like this line right here is 20%, the first bar. And when the S&P has an up year, the average up year, the median up year is close to 20%. So in most up years, you're giving up a good chunk of the upside. There are a few years where the S&P does have modest up returns, such as 2005 at 5% return, 2007 at 5.4, 2015 S&P had a little less than 2%, and in the early 90s you had 7.6% in 1992. Those were the 4 years in the last 30 where you had S&P 500 returns lower than in 2011, 2%. Those are the 5 years you had in the last 30 where you had S&P 500 returns positive, but lower than the historical average of 8%. All the other up years in the S&P 500 in the last 30 years are up more than 8%, and therefore you missed out on upside with that covered call strategy. And meanwhile, on the other side, the down years since 1993 have all, with the exception of 2018, where the market was down 4%. Every other down year, which totals to another 5 down years, the negative returns exceeded 9%. 2000 was -9, -12 in 2011, -22 in 2002, 37 in 2008, and in 2022 you had -18 on the S&P. And that's year to end, and that includes usually the end of the year rally that market seasonality gets you. So you're going to have drawdowns that are likely bigger than that. So you're going to eat big losses, and you're not going to participate really in any of the market upside, or very little of it. And then you could counter to me and say, well, what if I sell them out of the money? Say like 10% out of the money. So at least I get 10% of the upside. And then I can make some extra income. Well, if you sell it 10% out of the money, that 8% yield drops down to a 3% yield on those calls. And that is an environment where call skew is relatively high. And interest rates are higher, and when higher interest rates, it increases the yield you get from options, because of the fact that you could put that money in cash and collect a yield from the bond. It's called parity. So it could be a lot lower than that 3%, 10% out of the money 1 year out on the S&P 500. And so therefore you do get a little bit more upside. Those up years, you're capping your upside at 13% versus 8%. Doesn't change that most years you're going to be giving up upside. But now, if the market moves down, instead of getting 8% of cushion, you're only getting 3% of cushion. So yeah, if the market is a bear market down 20%, that 3% I guess does a little bit, but it doesn't really insulate you that much. So you're just not getting compensated for selling variance in a market that is high variation. The only really way this makes sense is if the options are structurally overpriced. However, if you think the regular equity market is efficient, the vol market tends to be even more efficient. An index vol tends to be a lot lower than single stock vol because of the canceling out effect of having a basket of 30 to 500 stocks, depending on which major index you use, to cancel out some of the volatility within each individual company. So you get much lower vol in these indices than you would in a single stock. So yeah, basically it's not as bad as, say, selling naked options or selling naked puts, which a lot of people do is also as an income strategy that aren't but cash secured. But when it comes to covered calls, they're still you're not getting compensated to bet against variance in a market that tends to have a lot of variation. That's it. Okay, so yeah, and saying, Nick, okay, you're right maybe about the S&P. S&P options don't compensate me enough given the interest rate environment and given the fact that I'm giving up a lot of the upside for not much downside protection. But what about single stocks? The problem with the covered call strategy for single stocks is the distribution of returns for single stocks. It's not really a normal distribution, at least on the short term, maybe a 1 month time frame. It's a normal distribution, but 1 year, 5 year, 10-year horizon, the curve is heavily skewed to the left, whereas the majority of stocks have negative returns and an overwhelming supermajority have sub-market returns. And if you stretch it out long enough, in a 10-year horizon, you have 55% of stocks have a negative return over the past 10 years, with a significant chunk of those going bankrupt outright. The bulk of returns in an index are really just from a few small winners who, not really small winners in terms of the size of the company, they can be very big companies because if you're compounding at those rates, you do become one, but in terms of the small number within the basket. And so if you lack the confidence to bet on the full upside of the stock, why would you mitigate that risk through a covered call versus just exiting the position? And if you're concerned about taxes, why don't you just put on a collar or a protective put? That seems to be the more optimal strategy because the odds are, given the negative distribution of returns of single stocks, that covered call there's a good chance of expiring worthless, but that's because the stock is going down. You're probably going to have a better long-run return by just selling the stock than rolling covered calls for 5 or 10 years on that same company. And if you have enough conviction that you don't want to sell the stock, then you should just take the chance and ride with the company, because the distribution, say like the average return is about 20% for a given stock over a multi-year period. The problem is that just because the distribution is so skewed to the left, you have a few winners that have much higher returns than that, while the bottom 55% are outright losing money. So if you think you have one of those companies that is going to be a consistent compounder, you're going to be giving up a lot more upside than you are selling those index calls. However, if you're don't have that conviction, then there's chances are the stock's going to be at a lower price 5 years from now than when you bought it. And so maybe the covered calls will help recoup some of that loss, but they're probably not going to, it's probably not going to be worth the extra hassle and probably not generate much more yield than if you just got out of it and reallocated it into a better investment. That is the flaw with covered calls for single stocks. And NYU's Amniti Petagisto did an excellent paper on this, which I will have in the description of this video, explaining the skewed returns of single stocks. So that is my concern overall with covered calls. The bottom line is that you're not getting extra real income. You're just betting against variance, which based on the historical price distribution of single stocks and the historical return lumpiness of the S&P 500, you're not getting compensated fairly to take on that variance. And when but the other counter argument I'm going to get here as well is, well, why don't I just wait when volatility is high? If I have VIX in the 30 plus, why don't I could collect a lot more premium by selling those calls. Same time, when VIX is 30 plus, that means there's a much higher risk that there of a permanent impairment of capital and a bear market that just comes and crushes either the index or your specific stock. So yeah, that's one counter argument to that. And if you really want to participate on long run upside, if you really want to collect premium when everybody's afraid, you're better off selling the put, because then you could be put into a stock at a much better valuation, and you could collect premium to pay to wait to buy at a better time. Whereas selling calls into that, one, if things get worse, it's probably not going to protect your downside, especially because when vol is that high, skew tends to favor puts, and so therefore the calls won't be generating as much premium as the downside, because people are looking to buy protection when they're scared. Second, on top of that, you have if you're wrong, and let's just say the market does go up, then you're going to be you're more at risk of giving up a lot more upside than you would in a normal market when vol is at its historical levels. And if you look at the distribution of S&P returns, the periods that have the most rapid upside are usually just right in the wake of market bottoms. 2009 was a good example of this. The post-1987 crash rally, early 1982, COVID in 2020, usually like the Red Powell cut rates in 2018, early 2019 was a good other example of this. So you have a higher probability of giving up a lot of upside too. That's why the vol is higher, because the variance both ways is a lot higher. And so if you're betting against variance, you may get compensated a little more, but you're also from higher probability of that working against you. Overall, that's my thoughts on it. Whether it's high vol environments or low vol environments, I don't think that selling covered calls is a great idea. I'm going to put that study about stock returns. I'm also going to put a link to a good paper from my friend Chris Adel-Massey, who goes into more of the mathematics on this. He wrote a couple of years ago called Selling Calls. It might be passive, but it ain't income, which goes into more of the theoretical framework of how put call parity explains why covered calls are not optimal. But just from a market practitioner's perspective, I've explained some of my thoughts on why. That I've never really liked this strategy in my entire career in markets. And that will wrap it up. Let me know if you have any questions or thoughts on this. I've tried to kind of go away from theoretical economics and do a more purely finance video. And if you like more of these, let me know as well. And please share your opinion on what type of videos you want to see more in the future of this channel. Thanks for watching.